The Iran war just triggered something most people don't even realize exists. A margin call on entire countries. Yeah, just like a trader gets a margin call in their brokerage account, countries are now being forced to sell gold. Not because they want to, and that's an important distinction to make, but rather because they have to. It's got to that point now where nations are being margin called. Think of it like this, of an analogy or an example. Imagine you've been saving up gold for years. Think your Chinas, think your Irans, think your Polands, stacking it diligently, protecting your nation's wealth, protecting your future nation's prosperity. And suddenly, your bills explode overnight. You don't have enough cash. You don't have enough liquidity. You're worrying about how you're going to pay your militaries and your defense budgets in the next few quarters. So what do you do in that scenario? You rush to the nearest pawn shop and you sell your gold just to simply survive.
The dollar buys time.
That's exactly what's happening right now, but on a sovereign level, on a nation state level. Turkey just sold around 58 tons of its gold in just 2 weeks. And it's not the only nation state that's doing it. Other nation states are selling to raise capital. Now, in that scenario, that's not a strategy. That's pressure. That's existential survival. That's needs be, needs must, necessity. And if it isn't crazy enough already, here is the truly insane part. This forced selling could either crush gold prices, like most logical people would assume, or, my line of thinking, create one of the biggest buying opportunities in decades. And in this video, we're going to discuss exactly why it is the latter. So let's break this down simply. Gold margin call on a central bank sovereign level. Now that's going to entail forced liquidation. It's also going to entail things like capital flight and other issues. We're going to be discussing currency pegs, when currencies get pegged to one another, and a 3-phase playbook. So let's go ahead and discuss those things in more detail. So let's talk about the actual stats and the numbers that go along with it. We saw forced selling at a huge level. So we not only saw forced selling, but we saw it in a very, very interesting way. 58 tons left Turkey very, very quickly. In just 2 weeks, 58 tons. 43 tons outflows of global ETFs also were hemorrhaging out of the markets. 45 tons left the London vaults as well. Now, all of these things helped contribute to a really, really selly market, if that's even a word. Now, every man, woman, child, and grandmother knew that gold was on an insane parabolic run. Central banks were buying like crazy. Hedge funds were sending out research notes like I've never seen before. China, India, Turkey, everyone and every other third nation were buying gold. Everyone. It was like a new gold rush. And the prices, they kept going up. Further. I've never seen gold prices moving like that in all of my time in the city, in trading my own book, and in being a professional or an amateur in the investment market field. People were calling for 6,000, 7,000, 8,000, 10,000 gold. And then suddenly, it dropped precipitously. it dropped like a rock. Well, not a barbarous relic or barbarous rock, but like gold does in these cycles. Hard, convincingly, painfully, it dropped massively. Now the media says things like, oh, these can be explained simply via profit taking. It's just a technical correction. It's just the market rebalance, people rebalancing their portfolios. But that's not signal. That's just talking heads on the television and their noise. Because behind the scenes, something much, much bigger is actually happening. Here's the real mechanism.
Strait of Hormuz were closed.
Think of a country like Turkey. Not the food, it's delicious, I know, but a country like Turkey. Their economy is like a household. They've got problems, they've got inflows, they've got outflows, they have to balance their books. But they've got a big problem. They import almost all of their energy. Now, imagine your electricity bill triples overnight. That's not hyperbole. That's exactly what happened when oil prices spiked because of the war. A country like Turkey, a household like Turkey, with no domestic energy production, sees their bills skyrocketing overnight. Every $10 incremental increase in oil costs puts them billions of pounds in the red each quarter, each week, each month, each year. So now they have three vital options. They can let their currency crash. That's never popular domestically. That makes importing incredibly difficult, spikes inflation. They can burn through all of their savings, their dollar savings, because the lira, let's be honest, internationally isn't really accepted everywhere with alacrity. Or they can sell their gold. Gold was not only being used to raise capital quickly, but it was also being used for future expenditure. So gold in Poland was announced 550 tons was going to be going towards defense in the future. What does that mean? That means the gold in Poland is absolutely getting nuked and being sold in the market, which is obviously a downward pressure. Now, it's not immediately, it's over a 5-year or a 10-year timescale, but nonetheless, that's going to be a downward pressure on the price of gold. Now, Turkey's gold is sizable because it was 10% of their actual stockpile, which is a big amount to sell all of a sudden, which could also signal that maybe in the future we're going to be seeing a few more purchases being delayed and a few more sales being expedited. The key insight is that Turkey alone created more selling pressure than every gold ETF investor on earth combined. And that helped contribute to a 15% drop in the price of gold, which is completely liquid, completely fungible, easily done, and attractive all around the world. Option one leads to a political disaster at home. Real regional and domestic instability can occur because of that. Option two, they're already running low on those reserves in Turkey and other countries of the same ilk. So they choose the only option that's viable, and that's option number three, to sell their kitchen sink. No, to sell the gold. Now, let's make this even clearer. Think of a country like a shower, or a sauna, or a bathtub full of dollars. Money comes in through the faucet and it leaves through the drain. Think of the bathtub analogy as a country. In normal times, in happy times, in stable times, the faucet is strong. Money flows in steadily, governments collect tax receipts, they can plan out into the forward curve, they don't need to worry about immediate spikes in energy prices. But now, look at our conditions now. The faucet is slowing down. The faucet is coming to a halt. It's a trickle and no longer a flood. So something else has to happen. The drain is wide open still, remember. Not just that, but another added pressure occurred. Russia, long-term buyers of gold, actually ended up selling $30 billion of gold as well at the same time. And we had China pausing their gold purchases for a few months as well. So we did have these pressures building up in the system before we saw this cataclysmic event actually occurring. But to understand it, we need to understand how currency pegs also work. So currency pegs essentially are countries keeping their currencies pegged to another one. Normally, it's going to be the reserve currency, which in this century, in this iteration, is the United States dollar. It used to be the British pound, and it used to be the Dutch guilder even before, and other currencies throughout history. So if we imagine dollars in this tank, and we have inflows coming into the tank and we have outflows coming out of the tank. And let's imagine we have our Gulf nations here, like Saudi Arabia, Bahrain, we have Qatar, and we have all the other ones in the countries that actually have de facto pegs to the United States dollar. Well, whenever the dollar strengthens too much, they have to rebalance it by spending dollars. If the Strait of Hormuz gets closed and oil can't ship, then that means there's no dollars going in. We're going to cancel those dollars out. But let's remember that 80% of the food in Saudi Arabia is also imported, which means dollars must be leaving. So there's a double pressure. You've got lots of things leaving and you've got things still coming out, which means it's difficult for you to balance your book at the end of the day. The expenses are still there, the bills are still racking up, the liabilities are still there, the obligations never went anywhere. So the water level starts dropping, and it drops, and it drops, and it drops. And then, like that Hemingway quote, they go broke slowly, and then all of a sudden, really fast. Now, other than the obvious, here's the intrinsic problem. If the bathtub empties, if Turkey empties, if these countries around the world with instability energy imports come to a trickling halt and get completely emptied, the entire financial system starts to collapse. So what do they do? What do they do in that situation where their regime, where their government, where their going concern seems to be imperiled? Well, like you do when you are a retail trader or an individual trader or even a hedge fund with a large book, they grab whatever they can that is liquid and they pour it back into the tub to make it whole. It's like your broker ringing you up and saying, hey, mates, add a bit more because you're coming close to a margin event. You need to top it up or we're going to sell these positions for whatever it is. Doesn't matter, we're going to mark to market it to cover your losses and to protect ourselves. And the whatever in this scenario isn't grain, isn't oil, obviously, it's gold, it's metals. Now let's talk about the Gulf countries because they are incredibly important and are not spoken about as regularly as they should do.
Sierra formation, this is the flagship. Increase speed to 20 knots.
So let's imagine if we have this whole tank representing our countries in the Gulf, and they need to have those dollars flowing in, and they obviously have the dollars also flowing out. Well, this whole issue with Iran has actually limited and truncated the ability for them to get money out in terms of their oil exports. So oil's not getting out, which means their dollar amounts coming in are obviously going to be greatly diminished, which creates a crisis. In that scenario, what do? You don't have the normal store coming in, so you have to go into your backroom warehouse, your reserve tank, which is obviously full of gold. And that's how you raise the capital to enter it back into your reserve tank. Now, the choices these governments have to make are all at once rather difficult and rather unenjoyable and actually not very pleasant. So they have three choices and all of them are very, very bad. They're not happy choices to make at all. You can let your currency crash. So you can let your paper money crash. You can burn through your reserves of cash. And you can sell your gold. In one of those scenarios, great instability can occur. in another one of those scenarios, your currency can collapse or crash. And in another one, you have to sell your gold, which is like your piggy bank for the future. So letting the currency die is actually impossible. That's impossible for a variety of reasons. We can't have the currency crashing because for political reasons, it's absolute political suicide. It's income tax averse, and it's going to lead to like systemic collapse going on here. In terms of our burning through our dollar reserves, that actually should have been this one, we are going to be burning through our reserves, which are very important to our balance of trade, to our ability to fund our government in terms of monetary policy. So burning our reserves are also very, very unpalatable. Unpalatable, yes. Unpalatable. And obviously, selling our gold is not the best thing to do, but it does allow us to get a load of cash right now. So it actually, on the balance of things, probably is the best one out of all of those undesirable options. And that's what they do, which obviously exerts a huge amount of pressure on gold. So right now, we have a few forces in this world pushing down the price of gold. So what are the death knells for gold right now? What are the death knells for gold right now? What's actually happening in this market that's forcing it to go down? Well, we have the oil shock coming. We have the peg that we've spoken about before, and we have the war, which is obviously incredibly existential and is going on right now, which is forcing these governments to readdress how they actually create their reserves and how they manage their reserves and what they are going to do in terms of funding their governmental balance sheet in the future. So with the oil, importers are really struggling. You're going to see your Turkeys, you're going to see your Indias, your Chinas, your Koreas. All of these countries import vast amounts of oil into their countries, which means they are incredibly, incredibly sensitive, which is why we see all of these countries being negative sellers of gold. And then we have our nations who are pegged to the dollar. We have the Saudis, we have the Qataris, we have the Kuwaitis, we have the Bahrainis, we have the Omanis. All of those outflows are occurring out of their systems where they are actually in the worst, most precarious situation possible. So they're seeing all of these scenarios occur when they really, really actually need dollars, but all of the dollars are actually going out. Now, one of the most important ones is the war. Now, the war is negative for gold, paradoxically, because all of these countries are actually having to be sellers of gold in order to raise funds for future defense spending. So these are the three unholy conflagrations that are actually occurring right now in the market that are leading towards gold being sold off in a variety of different fashions and manners.
Breaking news, the Islamic Republic of Iran has announced further escalation in the Gulf. We are seeing unprecedented movement in the oil markets following the sanctions.
This is where things get even more intense. The Gulf currencies are pegged to the US dollar. And if you don't know what pegged means, it basically means they are promised. It goes like this. Our currency will always stay stable, in line, and not deviating too much away from daddy. I mean dollar. That's how a peg works. Think of it like holding a line in a tug of war. You can't let it go. You can't let it deviate too much or you will be pulled to one side, which means your imports, your exports come all out of whack, your domestic population becomes unsettled, inflation runs rampant, and controlling your financial conditions become ever more increasingly difficult. If you do let go of the rope in the tug of war analogy, everything collapses: confidence, economy, stability, and most importantly, politicians, because let's be honest, the business of government is protecting government. So here's the issue, other than the obvious. The income depends on oil exports in the Gulf countries, obviously. And the war has disrupted that flow. It's disrupted a business model that was literally printing money. So now, less money is coming in, more money is going out, people are realizing we have to invest in defense alongside AI, alongside quelling our domestic population's grievances, and they still have to defend their currency, which is actually probably the most important variable in all of these calculations. So what's actually left? They have to sell the gold. Can you see why all roads here are leading to selling the gold? This is why we are seeing prices like this for gold. In an event that we think is risk on, or in an event where we think is a haven bid, we're seeing selling because it's mechanical, it's structural, it's necessary. That is the margin call. Just like in trading, just like when I was trading a long time ago, when you get a margin call on a retail account, it's painful and it has to be sorted out very quickly or you're going to run out of money. And when you run out of cash, you can no longer participate at the table. You're forced to sell your assets at fire sell prices, even if you don't want to, even if the trade is right, even if the macro direction, even if the narrative is propitious, even if your positioning is auspicious, even if it's the worst possible time, and then 2 hours later, everything's rip-roaring again. So is the bull market for gold still actually on? Are we still in a bull market, or is it going to be the winner that is the bear? That's going to be the overall ultimate warrior winner out of all of this? Well, to understand this, we need to talk about it in terms of the short-term headwinds. What are the short-term headwinds? ST, what are the short-term headwinds? So we have already discussed our forced selling. That's one of them. We have Turkey, we have the Gulf states, and we have China and India and Russia. We also have what's going on in China. China have paused buying their gold. So it's the biggest buyer gone. The biggest buyer is now gone out of the market for a short amount of time, I'd imagine. And we also have a dollar that is very, very overvalued right now. So those are the short-term headwinds. But what are, in green, are long-term tailwinds? Long-term tailwinds here. So our long-term versus our short-term. Well, our long-term headwinds are that rate cuts on the balance of things, according to Mirror and according to other Federal Reserve officials, rate cuts are still on the cards. And we also have a huge, huge green candle here that's associated with the dollar being absolutely debased and absolutely trashed, and also de-dollarization. So those things are still in the mix. That narrative picture that connects all of those things, the narrative is still overwhelmingly propitious and supportive of gold. Not to mention the fact that we're talking about a Russia parallel system, we're talking about the yuan, and we're talking about BRICS as well. So all of those things lend very, very big tailwinds to gold. America is exporting the largest amount of gold it ever has and contributing to GDP to a level that I've never seen before in my entire financial career. Think about it like a store suddenly refusing to sell its inventory. Less supply is going to obviously hit the shelves, hit the baskets, and hit our households. But think about that on a global level. All at the same time, simultaneously, other countries are dumping the gold to raise the cash. You can start to see how all roads lead to a lower gold price. So you've got all of these things all together. Forced sellers pushing prices down. You've got countries having to raise money via gold sales. You've got supply restrictions tightening the market. You've got prices in Asia dislocating from the CME and other exchanges around the world. You've got LME not being able to fulfill order quotas. It's like pressing the gas and the brakes at the same time all around the world. The volatility absolutely explodes. And that's what we're seeing in gold prices right now. So right now we have those three major forces hitting gold. The first force is the energy shock. Countries need the dollars to pay for the expensive oil that's coming ever more increasingly expensive every day. So they sell gold to raise those capitals. Secondly, Currency pressure. Dollar-pegged countries, especially in the Gulf, must defend their currencies, so they have to also sell gold. And third, war funding. War funding has become a real consideration right now on balance sheets. Countries need cash for military spending, so they are as well selling their gold. And at the same time, what's happening all around the world, concomitantly, simultaneously? Big buyers like central banks are stepping back. They're walking away. They're starting to think we cannot actually sustain this level of gold purchases. So obviously demand is dropping. Demand is going to drop in that scenario. So you might be thinking this is a bear case for gold. This is a death knell for gold. This is the end of the bull rally. Is this the end of gold, you're asking? Me, you're asking yourself. You're looking at yourself in the mirror, you're wondering, you're asking your pets. Well, not necessarily. And I actually think the case for gold has got even stronger given all of the dynamics going on around the world. The macro picture hasn't actually changed once we get the Iran war out of the way. Because if you zoom out, it starts to look actually very, very different from a variety of perspectives. Think of it like a clearance sale. Think of it like getting out the liquidity. Think of it like clearing out all of the leveraged buyers, not because the product inherently is bad or inherently is toxic, but because the seller is incredibly desperate. They are what they call in the market the weak hands. Now, what does that actually mean long term? Well, long term, nothing really actually changed. The debt is still rising. De-dollarization is still going on around the world. Money printing is undoubtedly likely to continue. Quantitative easing is around the corner, coming to a theater near you. Yield curve control is probably coming back to suppress volatility and bond yields. Currencies are still very much under pressure. Oil is still very much in demand. Volatility around the world is still going on. And historically, one thing happens then. That's exactly the environment where gold really thrives. Not to mention real yields, nominal yields, inflation adjusted yields. So what we're seeing right now isn't simply a crash. It's not just a crash. It's a forced reset, a forced paradigm shift, a forced new mode of operations, a liquidity squeeze, squeezing from the weak hands to the hands that can sustain it for the long term. A global margin call on a sovereign level, which in some ways makes me feel a little bit better because it's not just us who get those margin requirement calls or have to be cognizant of them. We now see it also extends on a sovereign level. If you've enjoyed this video, my name is Justin. This is the House of Trade. Give me a like, give me a share, subscribe, or don't. But whatever you do, don't take your eye off the golden ball. Ciao for now.